When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from the other Jeff on this radio program. That would be Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, happy fall weekend. How are you doing?
I'm doing great. Thank you. How about you?
I'm doing well, thank you. Frosting the pumpkin in some parts of the country. Some snow flurries out in the Midwest. License plates turning here in the greater Tucson area. Jeff, did you see this? I've been fascinated by this video of Elon Musk's SpaceX rocket. I guess it was the booster, that came back to land. And boy, that was an absolutely perfect landing. And that thing was not light. What is it, weighs a couple hundred tons, something like that?
No, a couple hundred tons, a couple 100,000. It's like 250,000 tons, according to Elon Musk. I heard an interview afterwards, and he was, marginally impressed with his engineering. I also saw an interview. They were asking his brother, "What do you think of, Elon's deal?" He says, by far, there's no engineer on the planet that's better than him that understands science and stuff. So, I mean, he's not just a businessman that asks the government for money and has a great idea, hires smart people and builds electric cars and different things. I mean, he's got these ideas in his head. I mean, he's just an amazingly intelligent guy. And amazingly impressive. I think it's even more impressive on his deal making. I actually talked to a guy that said he was in one of the government meetings where he was asking for money. He says, and everybody looked around. Nobody had a clue what he said, but they gave him the money anyway. I was like, oh, okay. He pretty smart. But anyway, it's coming down to what he knows and what he does makes sense. One of the things about NASA compared to SpaceX, and this is what has got me, is he's actually creating ways to salvage parts and not just throw money down a black hole like the government does. The government doesn't care. They'll throw, just let the millions and millions and billions of dollars worth of rocket parts fall in the ocean. We'll just get more taxpayers' money and do it again. Mm-hmm. Elon Musk is like, no, we're doing this for profit. We're going to try to make money. We're going to take things into space for companies, satellites, and things like that. We're going to even contract with the government. Why do we want to be buying? We want profits. We want to make stockholders rich. We want to do the smart thing. Who says capitalism doesn't work? It totally works. It's the only thing. I mean, shoot, if the government worked like a business, we'd pay a lot less taxes and we'd have a lot more stuff going on in our favor and everybody be happy. But the bottom line is they just take our money and use it for stuff. Elon Musk is saving all these parts. I mean, I don't know how many millions or hundreds of millions or even $1 billion this rocket project cost. But, I know his net worth goes up 15 or 20 billion a day, up or down every day. So, I mean, $1 billion is kind of like dollars to you and me. But the cool thing that they can actually reuse these projects by spending a little extra fuel and a GPS device, homing device, kind of like a drone, that'll take itself back to the launch pad and a totally custom catcher's mitt, so to speak, rack that catches this thing falling out of the air. And it was interesting hearing some of the comments that like, oh my gosh, that's coming down fast. Oh man, that's too hot. There's no way it can land. And then all of a sudden those rockets fired up, slowed it down, and it just eased right into that thing. It was mind blowing. I actually started out as an engineering major. I kind of wanted to get into, building that kind of stuff, and ended up calculus honestly hurt my head, and financial math didn't. So I ended up using my math skills elsewhere. But that stuff fascinates me, and I'm just incredibly impressed that they got that to work. And that was the first try at it. So they've blown a few things at first, like. I remember Elon Musk, after one of the rocket launches, it like sputtered out or went up and crashed. He goes, well, that didn't work. He was like, well, what do we do? Let's go do it again. But they caught that thing. I think that also lends, just the whole concept is why I heard Trump earlier this week announce that Elon Musk actually wants to be and will be the, czar of cost cutting. I hate to use the word czar. He wants to be in charge of cost cutting for the government. And, why can't they go in and use that kind of a principle? It's like, why do we keep wasting everybody's money? Let's treat those dollars that we take from taxpayers as sacred dollars and use them for bettering America, not just throwing away to get votes or just throwing away because we can get more and not being responsible. I mean, the government has never, in my opinion, been good stewards of our money at all. Decent stewards of their own, I suppose, because they can do insider trading and all the other fun stuff we can't do. But they don't respect my money. And I think just that whole idea that Elon Musk is trying to penny pinch and, make a business out of the space program. Why can't he make a business out of all the other programs that the government's got their fingers into? And I think that's a great idea. I'm looking forward to it. I don't hope Trump wins just because of that, but that's one of those icing on the cake thing. I think if Trump wins, we'll have a lot better economic backdrop for, a good market. People having to work a little bit less, work smarter, not harder, not have second and third jobs, can afford cars, have interest rates in a reasonable level, not too low because that creates inflation, but not too high because that creates stagflation and we can't buy stuff, except the rich people who are still buying things, making the economy look okay. But I think more than that is, I think the second time around, Trump's going to be a little smarter about who he puts around him. I think he walked in and just put a bunch of politicians and unelected bureaucrats around him that he thought just because they'd done the job before for other administrations, they could do the job for him. And boy, was he wrong. So, he went and fired him and now they're on a commercial talking bad about him. So I think he'll be better at picking good people around him. And I think Elon Musk is one of those people that I'm looking forward to seeing how his input, along with, Trump's own business acumen, can help America become great again and hopefully stop this tailspin into oblivion. And it's not just this tailspin, financially because of inflation. I mean, the market's doing great. It's kind of faking us out. It makes the whole world think that our economy's good, even though there's a lot of things that aren't. But I think he'll bring back, along with people like Musk and other people that he'll surround himself with, economic focused thinkers, smart people that can actually do it in a way that is, sometimes you have to break something to fix something. And hopefully they don't in this case. I mean, they're trying to do that with this soft landing. They're trying to, fix the market without breaking the economy. And the economy's already kind of broken. They're just not letting everybody know. I'm excited to see a Trump win and see the people around him and how they go about fixing these economic issues, because I think they have the capacity to do it if they get the right people in place and if government doesn't stand in their way and block bills. And I hate how they throw so much pork into bills that end up costing more than the bill saves and things like that. But I think that rocket launch has a lot of implications and made me think about a lot of things. I just went down 3 different rabbit holes with that, but it was really an amazing thing. It did. It got me excited. It's one of the coolest things I've seen in a long time.
Yeah, and he really is quite a pioneer, Elon Musk. But to see that do what it did, I know that this is for future space travel. I'd like to see it land safely about 3 or 4 or 5 more times before I get up there and take advantage of that opportunity. Anyway, he also had his AI showcase for these Tesla taxis. So we'll keep an eye on what Elon Musk is doing. You talked about the market, and the market has been unusually good lately. Is there any substantial reason why this market has been good?
Yeah, I think the only reason is there's still a lot of liquidity out there. Unfortunately, it's in the pockets of the rich people, not the middle class people. There's still the ability to buy. There's also other countries that are really not happy with their own economies, and they look to America and they hear the news headlines that, our economy's great and the job numbers are good. And, they think it all translates to, the U.S. economy's great. Let's just keep investing over there. So the liquidity and the money inflow, more buying creates an upward pressure in the market. I think the main reason is there's an election, and I think the manipulation is obvious, but it's not necessarily obvious to the main street. It's obvious to Wall Street and some of the insiders or people that'll peel back the layers of the onion and look into why, like I do. And honestly, I wake up in the morning on a regular basis and think, man, I'm way too old school for this market. It hasn't really used fundamentals to drive it, and it's typically been supported by earnings, revenue growth, and other things. And they're acting like earnings growth right now, we're expecting earnings to be less than the prior quarter, just because of this prolonged inflation. And yet, earnings have been already estimated low. So a lot of earnings, we're going into earnings season right now, people reporting the third quarter earnings. And we're seeing people beating estimates, but they're not beating the prior growth rates of, even 3 or 4 years ago. Even during COVID, things were growing better, especially tech was, profitable. There were some sectors that weren't profitable. But the thing is there's not that fundamental, the growth pace does not in any way, shape, or form support the growth track or the growth rate of the stock prices. Stock prices are so overvalued compared to history. Even people in other countries, including, the hedge fund managers, market gurus all around the world think that our market is very rich, very pricey. And they see that, there's been 7 or 8 rate cuts already priced into the stock market that haven't been seen. So we had one rate cut last month, and it was a double whammy rate cut, which typically is usually only used in emergencies or when we're in recessionary periods, which we are. If you look at economic indicators, we look at, housing starts down. We look at inflation up. We look at, producer price index has been consistently going up. It ticked down just a teeny bit, but the consumer price index went up, this month back up to about a 3.3% rate of inflation annually, which, they thought it was going to be down in the 2.5 range and, hope to get it down to 2. So inflation is still not a problem that's been fixed. And there's a couple of reasons for that. The market, by and large, acts on hype. There's so many households that own stock now, and I've talked about this before. It's over 60%. And when that happens, typically is a precursor of a big market crash, a sell-off, or a recession, when institutions actually start owning less and less stocks and are selling into the fact that private sector, the households, are starting to buy more and more because they're getting caught up in this hype and the fact that they say, oh, the jobs market's strong. Speaking of the jobs market, I just heard a few days ago that the actual, I read in good sources, research, things that don't get reported. Last month, jobs, supposedly ADP said they were going to go up by around 115,000 jobs. And somehow the government comes up with this number, 230,000 jobs were created in September. I'm like, what the heck? How is there such a big discrepancy? Well, we find out that 80% of the jobs that were created last month were government jobs, and also including part-time jobs. First of all, part-time and government jobs are just a drain. Well, part-time jobs mean households have to take extra jobs to feed their families. And right now that number is over 8 million households in America have multiple jobs in order to make ends meet. That is a sad state of affairs. It's never been that high. The other thing that they're not telling us is how many jobs have been lost. And in the last 5 months, there's been over 800,000 jobs lost and well over 1 million over the past year. I think it's 1.5 million or something like that. What about that? And these are good jobs. These are the jobs like, Boeing laying off people because they can't figure out the strike situation. We've got everybody from, Amazon, Meta, Google, everybody, all these big companies, major companies are laying off people in order to at least show some sort of earnings. But that just means that they don't have the productivity and the hands-on work that need to grow the company in order to justify the prices where things are. So we really don't have a robust job market. We have more and more part-time jobs coming up and more government jobs, which is really a drain. And I don't think they should be counted. In fact, I think in the past few decades ago, I don't even know how long ago they started doing it. I think it's fairly recently. I don't know. But when I first started looking at economic numbers, when I got in this business decades ago, I don't remember them counting government jobs. It was actually real jobs, payroll jobs that were private sector jobs was the one that mattered. And the thing is, government jobs, again, is just bigger and fatter government. There are so many government jobs and so much, ineffective, just waste. And that's just, kind of like I was talking before, we've got to be more efficient with everything from like Elon Musk with his rockets to, the government with what they spend money on, including layers and layers of employment and supervisors and this and that and the other and people that are getting paid. And why do they do that? Well, the more people, I guess, they have on government salary, the more votes that they're going to be getting because they know that, that's the hand that feeds them. And the other thing is they don't feel bad about it because they think there's an endless supply of money as long as there's people working hard and companies that are continuing to expand and live the American dream and private sector workers that are building businesses like me and you and a lot of people we know that have ended up paying nearly half their money in taxes so that they can just take it and throw it away on meaningless job growth. So it's frustrating to see those facts. Another thing that is interesting is when they said they were going to cut interest rates, typically when they cut interest rates, just like when they raised interest rates a couple of years ago to combat inflation, it affected short-term and long-term interest. It affected, short-term, mid-term, long-term bonds. Just about every bond fell because as interest rates go up, the price of old bonds that don't pay that much interest go down. And so we had this bond bear market big time, and the bond market went down, more than 20% overall. It's barely ticked back, but with the hope of rate cuts, the market started coming back. The bond market started coming back. And then there was rate cuts. And so, a lot of people, including me, I'm thinking, okay, great. It's time to start buying the long-term bonds. But here's the trick that Powell played, and it's really just a manipulation trick. And we're seeing it come back to haunt us. And we're seeing how ineffective this rate cut was. He only cut the short-term rate. He only cut the immediate rate. And so if he can give a rate cut, an immediate rate cut to banks and brokerage houses and stuff that just is a temporary fix, like a 3-month T-bill, for example, well, that's going to get us at least to the election with lower rates. But here's what didn't happen. The market, it didn't lower long-term rates. The long-term rates have actually started creeping up, which means the bond market started tanking again. So the inflation is back. Bonds are tanking again. I mean, gone down about 5% in the last month. That's too much when it should have gone up 5% in the last month. And there's just some counterintuitive things that have never happened before that are happening kind of for the first time and that don't make sense fundamentally. So, when you see those disconnects happen, there's because it's manipulation. It's not really complete market cycles that are playing out that are affecting each different aspect of the market in a normal manner. So, how long can this hold out? Well, I think they'll probably make it hold out till the election. They want the market to go up because the powers that be, and believe me, the Fed who says they are apolitical are not. They listen to whoever's in office and whoever's writing them letters. I mean, Powell got a letter right before the rate cut of 50 basis points, got a letter from Congress that's Elizabeth Warren and I can't remember what committee she's on, but basically a finance committee, I guess, said, no, we need to lower rates 75 basis points at least. You got to do it. Well, all that was just to hype the market and hopefully get us, maybe make the S&P hit 6,000, and get the powers that be elected. History shows that 90% of the time, if the market is trending up just prior to the election, that means just immediately before the election, like where we're at right now, is that the incumbent wins. If the market tanks, there's like a 70% likelihood the incumbent won't stay in. So the times that it hasn't happened are few, but when it happens, it usually is bad news for the incumbent, and a new regime can take, new players can take over the White House. So I do believe it's not based on fundamentals. Earnings are not growing at the pace. There have been like 3 years of earnings growth that is multiples of what we've actually had already built into the price of these stocks. There is 2 or 3 years of interest rate cuts that is already built into the price of this market if you look at history. So unfortunately, I'm a little bit too analytical. I told you I was an engineering major. I like to look at all the details. And because I do, I am scared crapless of the market. Yet there's these people that know absolutely nothing about fundamentals, nothing about math, could have dropped out of high school and still got a securities license and gone into the market, and they see it going up as the market's strong, because everybody says the market's strong, and the news says the jobs growth is great, the economy is wonderful, and it's better than it's ever been. It just isn't true. The economic indicators are down. The yield curve is still trying to uninvert and stay uninverted. You've got too many private sector households owning stock. That's dumb money owning more stock than the institutions. The other thing that's propping up the market is the banks are getting a holiday on all the money that they owe us, the taxpayer. Remember that bank short-term bailout that they gave them when SVB, Silicon Valley Bank, went out of business back a year and a half ago? They were forgiven all their bad debts. Basically, the banks didn't have to collect on their bad debts or write them off. The government basically gave them a pass. I think that to the tune of somewhere in the neighborhood of $4 trillion or something like that. And that's essentially quantitative easing, because the banks bought their own stock. They manipulated their own business models in order to create profits. Because they didn't have to take losses against their gains, they look a lot more profitable than they really are if they had to pay those dollars back to the Fed, which is this bank term funding program was supposed to come due last March this year. And it didn't. They just gave them another pass. And I'm sure they're going to keep giving them a pass until the election's over. And this is what I think. And this is just, don't call me a conspiracy theorist. But, I think the market's going to hold up. That doesn't mean I'm so confident the government is so manipulated that they're going to manipulate the market through the election, but I'm really leaning that way. But I'm still not going to trust the government that much that I want to go in and risk a ton of money where this market is at these high prices and the high historical valuations, and without robust earnings or any fundamental drivers, including the longer term interest rates, which really don't affect businesses in a good way, because businesses don't borrow money for 3 months. They get loans that they want to pay back in 3, 5, and 10 years. So the long-term interest rates really aren't helping businesses get more profitable, even though the idea is, if we lower interest, everybody will do better and the stock market will go up. But here's what I think will happen after the election is if the Democrats win, I think they're going to probably continue to prop up the market as much as they can. However, I think smart money is going to go, oh crap, here comes tax hikes, here comes all kinds of bad things. Let's take profits, let's count our blessings, let's take the money off the table. And I think there's going to be a lot of selling, which may actually create the market tanking before the end of the year, but after the election. It may also do that after the first year. Now, generally after an election, we have a decent market year because the election's over and everybody can focus on the market and do some things that are more productive and focused on financial stuff. But in the absence of earnings and fundamentals, I'm not sure that'll happen. So they might be fearful enough of the ramifications of a Kamala Harris White House that the market could sell off. Now, to counter that, Wall Street might say, oh, great, we're going to get tons of free money. We're going to get tons of bailouts. We'll never have to pay back our loans. Banks are going to say, it's off to the races. Let's just keep buying stock. And, that could actually drive the market up. And of course, it only helps the rich people and the people that have liquidity, not the poor people that are still having 2 and 3 and 4 jobs to make ends meet and feed their families. Now, on the flip side, if Donald Trump wins, I think they could, although the market will see that as a benefit, like, oh, great, Trump wins, we're going to have lower taxes, interest rates are probably going to get under control. Yay. Let's be confident in the market, even though there's no earnings now, there will be. So let's just keep the market where it is. At least, let's still believe in it. And it's okay. It's not a high risk if we keep our money there. But the White House, if they're ticked off about the situation, they could go back and start calling those loans. Hey, bank term funding's over. Hey, got to pay back. We're not giving you any more bailouts now. And that could have a ripple effect and make the market tank just as a vindictive payback for Trump winning. So there's a couple of reasons that, we definitely need to wait till, I think, the election just to see what happens before now and then. It's just a couple weeks away. And then we also have to see what happens right after that before I would get confident in the market. I think not until about the first of the year, we'll get a better picture of, if there's any economic fundamental changes that could be happening that would prop up the market and make it reasonable to buy where it is now. But I think either way, after the election, we're going to have some sort of a reset, some sort of a sell-off, some sort of a pricing event where perhaps the prices are going to go down to a better level, which is a better entry point, or just flat out crash because the economy is really the truth will come out and the economy is really not as good as it is. I'm not a doom and gloomer, but I've seen that we're in a cycle. And as much as everybody wants to believe it, and I'm an optimist too, the optimism that I have is we're going to get through this. America's a great country. We're going to weather the storm, just like, Florida, had a couple of hurricanes recently. They've weathered the storm. There's some damage, but you know what? They're going to rebuild. It's going to be all good. We're Americans, man. We fight, we scrap, we get out there and we make stuff happen. And most of us, and I think that'll happen even with the market. We'll get through this, but I do think that there's what I call some kind of a reset mode that we have to go through before it gets cooking again.
We're talking with Jeff Hogan on Premier Retirement Planning, Wealth Management here in Tucson and Mesa. We've been talking about the economy and the market and why things are so good. I think based on our conversation today that our listeners may have some questions. If that is you, give us a call right now, 520-780-9059. Request your no-cost, no obligation, no judgment Premier Retirement Roadmap, a chance for you to sit down in a casual environment and talk to Jeff about your concerns about your retirement, how the market and the economy may affect that, who's going to be president, any number of things we can talk about here at Premier Retirement as it relates to your retirement journey. Again, take advantage of the opportunity, no cost and no obligation. Make that call today, 520-780-9059. No cost for this, as I said. There is no judgment and no obligation. 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, time for a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making this part of your weekend. Of course, you're listening to Premier Retirement with Jeff Hogan. And I want to remind you that we're on the radio 4 times a week here on KNST, Saturday, 7 a.m., 9 a.m., and 1 p.m. Also Sundays at 11 a.m. And as always, if you've missed any of those times, we're also a podcast. Go wherever you get your podcasts. Search for Premier Retirement with Jeff Hogan. You'll also find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. You can also Google that, Premier Retirement with Jeff Hogan podcast, and that'll point you to the show right there. Our telephone number, 520-780-9059. If you'd like to come in and sit down and talk with Jeff, have a private consultation and a casual conversation about your journey towards a confident retirement, we're taking those calls this weekend, 520-780-9059. Leave your name and telephone number. Shelley will call you back on Monday and set up that appointment for you. Okay, Jeff, time for listener questions. Gabe is listening to us in Tucson, and Gabe says, I'm 65 years old. I have $600,000 in savings, and I'm very close to retirement. Where should I park my cash now that the Fed has started cutting interest rates?
Well, comparatively speaking, the interest rates are still pretty high. They only went down 0.5 point. So, you could still get high yielding money markets and things like that, better than 4, probably even pushing 5 still. Typically, and I mentioned this earlier in the show, that typically bonds, like if you did an aggregate bond ETF, I use AGG, that's a ticker. If you just want kind of an aggregate bond portfolio, that typically is supposed to go up when interest rates go down. The thing is as I mentioned before, they only lowered short-term interest rates, and longer-term bonds, everything more than 2 years out, is actually falling in value. So you would actually be losing money. However, if interest rates do eventually start ticking down across the board, like they went up across the board during the inflation fighting 1.5 or 2 years that we had just behind us, you should make 5, 10, or 15% maybe just on the price of bonds, if you wanted to set up an ETF. If you're talking and that's your liquid money that you don't want to put in the market, but you want to have accessible. And that would be speaking about maybe a brokerage account at Fidelity, Schwab, or whatever. If you are talking about your bank money, then, you can still shop short-term CDs. They're still paying pretty reasonable rates. But eventually those rates, if they keep on lowering interest rates, are going to be, less competitive. We're going to go back to that 1 or 2% era. I don't think we'll get back that low. But if we did, well, then we're going to be it's going to be boring, and we're going to all wish we'd have invested longer term for the long haul now. Now, there are still companies that are offering well into the 5s on annuities, like fixed annuities. There's single premium annuities, MIGAs, we call them, multi-year guarantees of 5 and even 10 years that can lock in over a 5% rate. If it's long-term money you just don't want to lose, and you're really not planning on needing it, you just kind of leaving there, you want to live on some interest, that's an option. But again, it's not cash. It's just an interest rate type of an account. I don't think we're going to find high yielding checking, anywhere. I don't think there even is. I haven't really seen anything that's competitive with a higher yielding money market savings type of an account. But I would shop banks. I don't think the big banks are really interested in paying you a lot of interest. They'd rather make interest by loaning you money and charging you a high rate, or just investing their own money in their own stock like they've been doing, than give you a competitive interest rate on checking or savings accounts. But you can find credit unions, and you can find high-yielding accounts at brokerage firms where you might want to tie a bank account to, but still have that money liquid, and you can move it back and forth when you need it.
Gabe, thanks for listening to us there in Tucson. Thank you for that question. And, of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is Ralph in Stone Canyon in Oro Valley. And Ralph says, what are your thoughts on principal-protected structured ETFs, exchange-traded funds, and using them in part of the more liquid section of the pie cake?
Well, Ralph, if you're a member out in Stone Canyon like I am, we could golf together and we'd chat for hours on it.
Here you go.
If you'd like my quick answer, I think that principal protected structured ETFs are kind of a new gimmick in the ETF world. They're not a bad idea. Honestly, I like the indexed annuities and IULs that have tax breaks that still create some liquidity. But if you want more liquid section, like how liquid do you want it? ETFs are liquid if they're principal protected. Obviously you're giving up some upside with that, and just kind of depends on that ETF. Now, a lot of ETFs that are considered principal protected are actually principal buffered. So be careful in how you approach those, and obviously look into the products that are right for you. But I have no problem with ETFs. I like the fact that you can trade ETFs on the open market. The principal protected ETFs, again, we typically put our principal protected money into longer term money that generates income, that guarantees long-term income for retirement, has some tax advantage either through tax deferrals or through IUL, the LERPs that I talked about, so that you have tax-free cash flow. And that's about 90% liquid, based on what you put in. Let's say you fund it over the next few years and $500,000 of it. You can borrow over the lifetime. You actually borrow the money against the death benefit tax-free, rather than actually just use it up like you would in an ETF. So there are some different tricks if you're only familiar with the stock market, which many of my neighbors out there in Stone Canyon are, just been portfolio managing. And that's got you where you are. It's made a lot of money. And sometimes it just feels like the same strategy used to get you to retirement and get you wealthy enough to retire in Stone Canyon is all you need to do for the remainder. But there are some options that you might want to explore, and that is in probably a different world or a different bucket. It might be a paradigm shift shift for you. But there are some insured accounts that are principal protected that might actually generate more through leverage, actually generate more rate of return than what you'd find on the ETF. But again, it all just depends on what your comfort level is and how open you are to new opportunities.
Ralph, thanks for listening to us there in Stone Canyon. Of course, our number 520-780-9059. If you'd like to come in and sit down with Jeff and talk about your situation, or if you want to make a golf date with Jeff, 520-780-9059. We appreciate you listening to us in Stone Canyon. And of course, we'll send out Jeff's book, Retirement, The Road Ahead. Jeff, next question is Rebecca listening to us in Swarita. And Rebecca writes, how can I reliably verify that a specific financial advisor is a true and full fiduciary and that they're not just conning and misleading me? Is there a respectable and independent professional group that independently investigates and reliably certifies that an individual named advisor truly acts as a fiduciary? I can't afford mistakes this time.
Unfortunately, you are right in asking that question. And unfortunately, a license called a RIA, Registered Investment Advisor, or even an IAR, Investment Advisor Representative, if you carry that license, it's a Series 65 generally, or Series 67 with some securities licensing. It's a different license that requires you to be a fiduciary. And so you can call yourself a fiduciary just by having that license. Now, there's other people that don't have that license that really aren't fiduciaries, or they're not even licensed fiduciaries that call themselves fiduciaries, because in any industry, even like insurance industry, which isn't highly regulated by SEC, it isn't regulated as a security anyway because it's insurance. Or if you're just a transaction-based advisor like mutual fund salesman or stock trader, you have a fiduciary duty. And all too often, people trying to get the competitive edge by calling themselves fiduciaries because they have a fiduciary duty. You really can't call yourself a fiduciary without the actual fiduciary license or registration, and many people do. Now, even though people have the license or registration in order to call themselves a fiduciary legitimately, they still do a lot of their business under a transactional format, and they really have their own biases. So here's the honest answer: is there is no real way to guarantee somebody is a full fiduciary, or in other words, is going to really do only the best for you. Now, each advisor, and I'll tell you, I have people that come to me from other advisors that, claim to be fiduciaries. I know they're licensed as such, and they only do portfolio management, or they only do one aspect of what we call the 5 pillars of financial planning. It's more about income planning, it's tax planning, it's investments in the right categories and filling the right buckets for the right type of either income growth or liquidity. And, what do you do for long-term care and legacy planning? I mean, I think a fiduciary ought to touch on all those things, and we do here. But just because I think it should be done one way, if you think it should be done a different way, I might be really psyched out about how good a fiduciary I am and truly believe that I am. And I'm talking for others like me that claim to be fiduciaries. Now, while there's a lot of people that just use that word loosely in order to get business and sucker you in and be a con artist, like you said, plenty of that out there. That really just have one agenda or one product, and they stuff everybody in the same box and expect that to be kind of their definition of a fiduciary. I don't always mesh. My values don't always mesh with yours. So I think, if you are going to consider doing business with anybody who claims to be fiduciary, sit down with them. Don't go in and say, here, I'm going to give you my money. Let's see how it goes. Is visit with them 3-4 times. I mean, I don't rarely do business on even as little as 2 visits with people that come in, unless they've been listening to the radio show for, years, or seen the TV shows, or visited me and been to some classes and things like that, they will. But, if you're meeting somebody for the first time and you're kicking tires, you should spend time with them, get to know what their value system is, get to know them a little bit personally. I think a lot of their personal values will creep into their financial management and what they consider a fiduciary advisor would be. But that person has to agree with your values and agree with your goals. And if they do, then they will probably set up portfolios that are managed appropriately with the right risk tolerance, with creating the right type of income. But just because someone says a fiduciary doesn't mean it's a good match or a good fit. There might be, 100 fiduciaries within driving distance of you that really are fiduciaries, not only in their mind, but in their clients' minds. But that fiduciary may not be right for you. So again, I think it's important to go out and kick the tires. I like people that come in and kick the tires. I would hope that, when you find us, we're your last stop, but we could also be your first stop. while you have a couple of visits in between to just see if somebody else might mesh better. I used to get butthurt about people not doing business with me because I thought, well, why not me? Why? But guess what? Everybody has a different style. Everybody has different liking. I'm a lot more safe money than I am risk money. I'm more the guy that would want to, protect your assets and be real happy that we didn't lose any money more than, the market went up 20 and we only made 5. Don't I suck as an advisor? Well, if that's what your goal is, to protect assets because you've already saved them for retirement, then we're doing our job as a fiduciary if that's what your goal is. Now, if you come to me and say, hey, I'm 10 or 20 years away from retirement, I want a good growth portfolio, and I stick you in safe money and it makes 2 to 5% and you don't have any growth, then I'm a horrible fiduciary for that person, right? So if I'm going to be a fiduciary, I need to take on clients that I'm not going to stress out about, clients that I feel like I can help. And you have to go with a fiduciary or somebody that doesn't just talk the talk or flim-flams you into doing business or tells you, don't worry about this. I'm the financial advisor. You don't tell your doctor how to recommend prescriptions. Don't tell me how to recommend stock. And, if they start talking to you like that, like they're arrogant enough to, know what's best for you without, getting your feedback or input, then, maybe you need to keep on moving. But, I don't think there's any reason that you shouldn't interview at least a handful of people that claim to be fiduciaries and find the one that makes sense, not the one that talks the best game. But I had a lady that, in fact, I just got an email from her yesterday. A few years ago, came in with a list of 20 questions that she got off the internet, and they were great questions. Everything from, you're not really supposed to ask, like, how much money do you have under management? How much, what's your rate of return for XYZ clients? Those are questions that's going to be different, specific to each person, really. But, there are a lot of really good questions that you can find on how to choose an advisor. Google it and you'll come up with some really good questions that'll help you get to know them better so that you won't be surprised down the road that you didn't get the fiduciary that was right for you.
Rebecca, that's a great question. Thank you for asking it. And of course, we appreciate you listening to us in Swell Radio. We'll send you out Jeff's book, Retirement, The Road Ahead. If you got a question you'd like us to answer on the air, get it to us by calling it in. If you want, you can talk to Shelley. 520-780-9059 is the number to do that. 520-780-9059. You can also go out to the website, Primaret.com. Use the contact page there. Of course, if we use it on the air, we'll send you out Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Hogan. And again, if you'd like to sit down with Jeff and ask your questions in person, we're offering you the opportunity to do that. We call that the Premier Retirement Roadmap. And again, it doesn't cost you anything to get that. 520-780-9059. Do that today, no cost and no obligation whatsoever. Jeff, earlier in the show, you talked about the market, being cautious about the market. How are you investing people's money? I mean, making money, considering what's going on with the market being overvalued, weathering these storms and not missing out?
Yeah, that's a big question. We always have that FOMO, fear of missing out. We could miss out on a great growth opportunity, but we're also guaranteeing ourselves to miss out on any market crashes or corrections that are long overdue, because cycles happen and they will happen. And I know they'll happen. I don't know when. The market always does what it's supposed to. We just never know when it's going to do it. And the market will do what it's supposed to. And it's supposed to get back to more reasonable value. And it will do that. It might take a decade to kind of settle out to where we look back and say, oh, yeah, that decade did perform about as much as we thought. We had 2 market corrections in 2028 and 2031 or something, and that did get us back to a normal. Now, it might not happen in 2025 or 2024. The thing is we're at a value where it may. So we have to be cautious. Now, here's the cool thing about products and the different things that are available that are not just risk money. And it's interesting that the securities businesses, the root word is secure. Anything that's a security has elements of risk. You can lose money in bonds. People found that out last couple of years. People can lose money in stocks. Everybody knows that who's had any stocks for a while. There's a lot of risk out there, and all the risk is in securities. But that's all Wall Street and the banks want us to know about is risk, 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 because, there's a lot of trading and a lot of, the volatility actually is really a money generator for the industry, because if people get scared, they get out and then they get back in. And every time there's a trade made, money's cranking out of those money machines, the Wall Street money machine. So how do you make the best of both? Well, about 25 years ago, there was new products that came out that are called index products that insurance companies decided to develop in order to compete with retirement savings. I mean, insurance companies were and still are one of the primary places that manage pensions. They're into the retirement business. They have to create income. They have to keep money secure in order to do that. They can't lose half of their multi-billion or now some, approaching trillions of dollars of portfolio value in order to manage people's retirements. They can't afford to lose half of that if the market sells off. So they have to create ways to structure a product where the principal is guaranteed or secured or reasonably so, and then get some upside. So they come up with this way to use the interest that they make on your money and invest not the principal, but only invest the interest through leveraging options on indexes. So they call these indexed annuities. They call them indexed universal life insurance is a good one. There is indexed whole life. I don't like that. But life insurance and annuities in the insurance business have really allowed us to continue to get upside with no risk on a big portion of our money. Let's say a typical client comes in and they want, I'll just say break it up in thirds, and it might be different ratios, but let's say a client says, you know what, I've got $1.5 million, so I want $500,000 in liquid money that is market based that can go up, but the other million I want to secure income. So maybe half of that goes into some sort of a LERP type program where you can generate maybe a $40,000 in tax-free cash flow for retirement, and the other goes into maybe IRA money, might go into something that's a fixed index annuity that can go up when the market goes up, but not go down when the market goes down. And maybe that's 2/3 of your money. Well, you could also, in times of good markets, you could put the other $500,000 into the stock market. And if it makes 10 or 20%, woohoo, you just made $50,000 or $100,000, on that account, and you still made money on those safe accounts. Well, if we think the market's going to crash, and you have the $500,000 is at risk, the third that's out in the market, and let's say the market plummets, and we have another 50% market correction like we did in 2008 and also in 2000, and now your $500,000 is $250,000. Well, you might be okay with that because you don't really need that to live on, but who's okay with that when you're not working? And you know that the prior two big corrections of that magnitude took 5 to 7 years for that $250,000 to get back to the 500 that you had. Well, if we're in times like now where that is a higher probability than making 20% per year, in my opinion, why don't we take the 500,000, make 5 or 6% on it, maybe even 4%, but have it be liquid. No, you're not going to lose money. In the meantime, the IUL money, Index Universal Life, almost all of our accounts this year that are market-based are making 9 or 10%. Okay, they're not making 20, but it's in a tax-free environment making 9 or 10 of the upside. We've got some indexes that are up 18 or 20%, even on our index products from a year ago. And now 2 years ago, we made 0 on those. But we also made a little bit of money in our risk portfolio, which was de-risked the prior year because the market was plummeting. And, we got out with about a 10 or 15% loss on our risk money in general. But that money has already been built back based on just creeping back slowly and surely. While the good years since the market sold off in 2022 have given us some nice returns on our index products. And now that interest rates are up and have been up for the last year or two, we can get higher, better performing payouts on our safe money. So again, there's clients that have been up 10 to 20%, generally speaking, on these indexed annuity products with no risk to principal. So I'm happy getting upside without risk when the market is defying gravity, because we're still locking in those gains, even though it doesn't make sense. We get to lock in those gains, and every year, every 2 years, every 3 years, whenever those indexes that we're buying into reset, we get to lock in those profits, and that becomes new principal. If your $500,000 grew to, let's say, $700,000 in the last couple of years because you invested in some really good stocks, the Magnificent Seven, the Nvidias, and the Googles and Metas and stuff that have done pretty well lately. What if then the market crashed? Well, you're still okay. So you have $700,000. The market crashes 50%. You're back to $350,000. Well, now you still have to wait several years before it even gets back to your original 500. What if you had that 500,000 in index product, you only made half the market and it was $600,000 and then the market crashed? You've still got $600,000 in that portion of your portfolio. So again, we like index products. We like principal protection. You've worked really hard to get there. let's not have to work so hard to keep you there, and let's work smarter, not harder. I mean, you can't time the market. Nobody knows when it's going to sell off. Shoot, 3 or 4 days this week, I thought the market was going to open high and open low, and when I thought it was going to open low, it opened high. Counterintuitive is the nature of the beast, and that is because Wall Street wants to manipulate you and your emotions into selling at the wrong time and buying at the wrong time, because they're the ones that are pulling the strings. They're the puppeteers. So, we don't want to have to stress out trying to outguess the market. We want to let the market do the best it can and let Wall Street pull all the games they can. When it's good, we're going to lock in profits. When it's bad, we're not going to lose. And when the market gets back to fair value, we're going back into growth mode. We're going to go back in. When the market settles down and everybody who's made, doubled their money in the last 5 years loses half of it, they're back to even. But you've been making 5% this whole way, or even 10% in good years, and locking it in. So you're still ahead of the curve. Every time there's a crash, our clients are going to be ahead of the curve. Now, every time the market gets out of whack and is irrational, we might be behind the curve if you want to compare yourself on a golf course to your friends and their robust returns. But they've had everything out there at risk, and you haven't. One thing I tell most of my clients, even on the first visit, is if you came here because you don't want to stress out about your money, then don't expect me to stress out about your money. I'm going to put you in someplace safe where I don't have to wake up in the middle and go, oh my gosh, I wonder how John Smith's portfolio is doing today. The market looks like, the Chinese market and the Asian market's crashed. We're going to probably open bad and we might lose a bunch of money. I got to hurry up and get up when the market opens and make sure I make some trades so we don't lose all our money. I'm not going to do that. I'm sorry. I'm too old and tired. I'd rather use index products that do it automatically. We don't have to worry about. And if we wake up and the market's down, hey, we never got below the last time our principal reset. We always are going to go up. It's going to ratchet up. It's not going to ratchet backwards, other than what we pull out to use and live on. But that's why we save the money in the first place. So again, that's really the nuts and bolts of how we're doing it. Now, the best thing to do, or additionally to just structuring into the different buckets, and I've only named 3. There's other things. There's structured notes. There's, what are you going to do for your liquid money and savings, for your cash flow? What about an income plan? Are these other products generating income? Are you taking withdrawals from some of them? If so, we have to make sure that the right product is set up for that purpose. But bottom line is, everybody's got kind of a different story, but the majority of the people that I serve are people that have worked really hard to save and really don't want to lose money. So that's our focus. The cool thing is there are ways to take advantage of this robust, irrational market without losing sleep.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about the market and the fact that it's doing very, very well for no sustainable reason, and how Jeff is investing people's money considering what the market is doing. Based on our conversation, if you've got questions, we've got the answers for you. It's called our Retirement Roadmap. We're offering it to our loyal listeners this weekend. No cost and no obligation for that. To get yours, call 520-780-9059. This Retirement Roadmap is really a 5-point retirement review. We'll take a look at your income plan, whether or not you're going to have enough income in retirement. Also, then we'll design investments to support your income plan. We've got a tax plan. We've got health care costs covered, and we'll also talk about an estate plan. If you do not have those areas covered, if you think you're missing out in some way in any of those areas, give us a call here at Premier Retirement and request your complimentary retirement roadmap. Again, it is not going to cost you a dime. There's absolutely no obligation whatsoever. 520-780-9059. Make that call right now while you're thinking about it. All you've got to do is leave your name and telephone number. It's that simple. Shelley will call you back during the week and find a time that's convenient for you and Jeff to get together. Again, not going to cost you anything. 520-780-9059. If you want to go online and check us out, do that. Premret.com, Premret.com, and you can request your plan there. Well, Jeff, we're out of time for this week. I'm going to thank you so much for your time, but most importantly, thank our fine listeners here in the greater Tucson area for joining us. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.